Welcome everyone to today's broadcast and our market update. We're excited you're joining us. As everyone is loading on to the call, just wanted to introduce ourselves. I'm Greg Patterson and I'm joined with my teammates J.A. Canady and Tara Gould, and we are with Atlantic Wealth Management here in beautiful downtown Morehead City. And we trust all of you and your families had a wonderful Thanksgiving. And I know we did here. Our team had a great time and just enjoyed some fellowship with our families. And it was really good to have a few days off, but we are glad to be back together and just excited about kicking this off today and this afternoon. So as in past webinars, I've reminded you, if we do have technical difficulties and we go down, just know that we will work hard to get back to you. And so I just wanted to share that point because it does not happen often, but it has happened where we've lost internet connectivity. So if that does happen again, just know that we'll come back on the call just as soon as we can. Also, to remind you, this is our last call for the year. I know it's sad that we won't do one in December, but we figured with everybody's busy lives and our end of year planning, we certainly wanted to just take the month off, and we'll come back together in January on the 23rd. So mark your calendars for that. But this will be the last update for this year. We do have a lot to discuss. We were talking in our meeting earlier today about how we probably should have planned this for Friday, but we're going to give it our best today with what economic data we have. And I think you'll find it beneficial and useful. At least we hope that you do. So with that, we'll go ahead and kickstart the call. And in front of you, you see the action items of what we hope to accomplish today. We're going to go over current market returns, share with you where the S&P 500 is for the U.S. equity index. We're also going to talk about the latest economic data, as we have done before in these calls. We'll update you on what has transpired since our last call. We're going to talk about our recession risk indicators dashboard and give you an update on that and help you to see what has changed and what we think our outlook is for the future. We're going to talk about the leading economic indicators, or the LEI, that's put out by the Conference Board and what that shows. Also, we're going to give you some perspective on past recessions and what that looks like around equity markets, stock and bond markets, and how that has played out in different time periods. And we'll share some perspective around that. I think it's helpful in these situations to take a look at what has happened before and see if anything looks similar to where we are today. And then we're going to discuss some important things to help you plan for year end. We only have 5 weeks left of this year. It will be gone in the blink of an eye. So we're going to give you some quick bullet points and action items to plan for your year end, and then we'll give a conclusion. But that's a mouthful. We hope that we'll be able to give you some impactful info that you can take away from this call and improve your lives. And so with that, let's get started.
All right, I'm going to kick us off here. The first chart that we're looking at today is the S&P 500 year to date. So this is January 1st through November 28th. I always like to give a little bit of background on the index. So the S&P 500, known as Standard & Poor's 500, consists of the 500-ish, 500 and a few leading publicly traded companies. And this is based on market capitalization, or market cap. So how we calculate that, you guys don't need to calculate it. This information is public information, but it's going to be the current stock price, and we multiply that by the number of outstanding shares. The reason we quote this index is because, and the reason we track this index is because it is known as one of the best gauges of the U.S. equities market. And so what we're looking at here is year to date. We did have a market low that occurred. We talked about this last webinar. This was on October 12th. The S&P 500 dipped down to 3,577. 0.03 if we want to be specific. I checked right before we hopped on, and it looked like we were trading at 3,950 or slightly above that. And so what that means is since the recent low, we're up about 373 points, which feels really good. And that's slightly above a 10% increase. Next, same index, S&P 500, we're taking a look at 6 months. Again, you're able to see that volatility, the ups and downs. I was thinking about this and looking back 6 months ago, we were closing out the month of May. And so what we did see is we saw a dip, and at that time it was a year-to-date low in June. July, we creeped back up. We peaked a little bit in August, back down. And as you can see now, we're trending upwards again. A little bit later in the webinar, we'll speak as to why talking about this volatility is important, but right now I just wanted to highlight the movement. And then last, what we're showing here, S&P 500, same index, we're looking at 5 years. So we're just looking at a longer term perspective here. Through the ups and downs over 5 years, the index is up just over 51%. So to put dates to this, we're looking at November 2017, taking this through November of 2022.
All right, thank you, Tara. Next, we wanted to just jump into latest economic data. And so it's been about a month, maybe a little more, since we last did a webinar update. And it's been a lot of data that's come out. And similar to the last call, it's been mixed. So some of it we'd say is positive and some of it we'd say is negative. But just wanted to kind of highlight through and talk through these bullet points here. The first being the housing market, which there's been a lot of talk about the housing market with interest rates increasing like they have this year. There's really 3 things we look at in the housing market. We look at new home sales, existing home sales, and housing starts or building permits. And so over the last couple of weeks, we've had data come out for October, the month of October. So there's always a little bit of a lag in the timing, but on all 3 of those. And it's been, in general, the trajectory of the housing market is in a negative direction, or has kind of turned around from where we have seen it, especially in the course of last year. We did have a little bit of a surprise with new home sales. They were up 7.5% for October, but existing home sales were down and housing starts were down as well for the month of October. Interesting in looking at the average or the median home prices, the new home prices have really held up, and we haven't really seen them decline yet, but the existing home prices have turned over and started to go the opposite direction. So we'll continue to monitor the housing market, but that's kind of where we see things now. In general, for new home sales, we're down year over year about 6%. Existing home sales are down much more, so about 28% versus a year ago. That brings me to the next bullet point, which is retail sales and durable goods, which both of these have kind of been a positive or a bright spot. The latest numbers for retail sales, they were up 8.3% over year, and they were up for the month of October as well. So consumers are continuing to spend, which is a good thing for the economy. We'll see how long that continues as we continue to have, higher prices, inflation, higher interest rates. But that's where we stand now. With durable goods, and these would be things that purchases that consumers make that are not consumable or that are longer term. Things like appliances, computers, electronics, tools, things that you would look at using for a longer period of time. But durable goods have been up as well, and they're up about purchases of durable goods is up almost 11% year over year. So again, that's a positive. The next bullet point is industrial production, which For most of this year, that has been kind of a bright spot, although we have seen that decline for the month of October, and there was some adjustment in the previous 2 months' numbers as well, and they adjusted those down. So the trend there with industrial production has been in a negative direction, at least over the near term. Inflation, and we look at CPI, which is the Consumer Price Index, and PPI, which is the Producer Price Index. Really, there's positive takeaways and negative takeaways when looking at these numbers. The negative is that they're still at very high levels. So the CPI was at 7.7%, the last reading for October that came out about mid-month in November, and the PPI was at 8%. So contrast that with the Fed's target of 2%. We're still very high in terms of inflation numbers. The positive is that the year-over-year numbers have been slowly trending down. So on the Consumer Price Index, which is measuring the prices of goods that consumers like you and I go out and spend money on, July was the height at 9.1%, and since then we've come down to 7.7%. Similarly, with the Producer Price Index, March was the high at 11.6%, and we were, of course, down to 8% in the last reading. So the year-over-year trend has been good, but it is slow. So I think we talked about last time, this is going to be something we continue to monitor and pay attention to how quickly or slowly we see, inflation move. Of course, the Fed has tried to combat that this year with the interest rate increases that we've seen. But I'm skipping bullet points now. So let's jump back to employment. We do have November employment numbers that will come out at the end of this week, but the latest numbers were as of the end of October. We did see the unemployment rate jump up from 3.5% to 3.7%, but we added jobs, so we added about 261,000 jobs. There was just some change in the workforce. So actually, it appears that some folks dropped out of the workforce to bring that unemployment rate up to 3.7%. So we'll pay attention to the numbers that come out at the end of this week on that front, but that has been positive. The other thing we look at is initial weekly unemployment claims, and they have stayed pretty steady in the 240,000 range, and we would say that that's not alarming at this point, at least not yet. So still kind of positive on the employment front. We have seen some news in the media, if you've paid attention. There's been some announcements of some layoffs, but we haven't really seen the impact of that in the numbers yet. The Fed, as I mentioned before, they've been very aggressive this year, and we expect them to increase rates again at the December meeting, which will be in the middle of December. And I think probably the consensus is a 50 basis point hike. So we're still in a rate increase environment as we stand now currently. And then the gross domestic product, this is just measures economic output. I think our last call was right before the release of the third quarter GDP number. It did come out at 2.6% positive. So we kind of reversed trend from the first 2 quarters of the year, having negative numbers reported to a positive 2.6%. So again, that is a positive. So as you can see, some of the news that has come out over the last month has been negative. Some of it's been positive. So we would say in general, it's just been mixed. And as we go forward, we continue to monitor the news that comes out on a weekly basis. But I think the big drivers are going to be inflation, the Fed's response, and how that bleeds through to impact profitability and consumer spending ultimately.
All right, next we're going to take a look at the recession dashboard that we're calling it. Again, a little bit of background. Definition of recession is a recession is just a significant decline in the economy. It's typically spread across different areas, lasts more than a few months. We generally see it in decline in real GDP, income, employment, retail sales, things like that. A recession begins just after the economy reaches a peak of activity. If you remember your economics class, the business cycle, once we hit that peak of activity, and then through trough, between trough and peak, the economy is in expansion. Expansion is generally where we spend our time. It's the normal state of the economy. And recessions are typically, or have been rare within the past or recent decades. But what we're looking at here is this dashboard, which consists of 12 different economic indicators. We've looked at this each time that we've had a market update. So what I like to do is just highlight the changes from the last time that we talked through this. And you guys can see here up at the top, job sentiment, just how employees are feeling about their current positions and outlook. That has turned to cautionary. And then if you look towards the bottom, you can see the yield curve has turned from cautionary to indicate a recession. The recession indicators, once they've gone red, at least the overall signal, the average to enter a recession is about 3 months. Based on current conditions, we don't think that's very likely. And looking at past recessions and what's happened, sometimes it's taken up to 13 months from the time the dashboard signaled overall recession to where we cross over. And the next one is just a historical recession and what the dashboard looked like at that time. Of course, you can see in prior recessions, all or close to all of the indicators were signaling recession. Right now, we are close. We just have a few indicators hanging on.
Yeah, and so another indicator we look at is put out by the Conference Board. It's a nonprofit, nonpartisan organization that updates 10 indicators every 30 days. And this one was just updated in November, mid-month. And the blue line signals year-over-year change in the leading economic indicators, those 10 economic indicators that they're tracking. And you can see in the far right-hand side of the chart how those have declined below zero, that midline, to signal that we're approaching a recession. The gray is the year-over-year percent change in real GDP, or gross domestic product. And so this was put out on the 18th, and it basically tracks those 10 indicators. 4 of them were positive and 6 were negative for the month, for that 30 days. It is now down 3.2% over a 6-month period between April and October of this year, which is a reversal from 0.5% growth over the previous 6 months. And it's just noteworthy. Most of the decline came out of the non-financial components of the 4 indicators that were positive. Those are manufacturers' new orders and average weekly claims. That still signals red. Still signals green on the recession dashboard. So this is also an indicator that we're looking at on a regular basis, and we feel like it gives meaningful data to what's to come. The gray bars that are the vertical bars there that signal past recessions. The most recent one was, of course, coming out of the pandemic, or right when the pandemic started. The prior one to that was in the financial crisis of late 2007, 08, and 09. So it gives you a sense of the time periods between those last 3 recessions and how that line does fluctuate between there. The press release was November 18th. The US LEI fell for an 8th consecutive month, suggesting the economy is possibly in a recession. And that is the one of the senior directors at the conference board. It reflects consumers' worsening outlook amid high inflation and rising interest rates, as well as declining prospects for housing construction and manufacturing. The conference board forecasts real GDP growth will be 1.8% for this year, year over year for this year, and a recession is likely to start around year end and last through mid-year next year. So don't ask me to pronounce that economist's name, but I can tell you, that's their outlook from the conference board. I think perspective is also helpful during this time, and it's not uncommon for us to hear, well, this time is different. And that could be true on several different areas, but I also think it's just impactful to look back to previous recessions. We've shown this chart before, but we come back to it because it is noteworthy on a couple of different areas. So number one, that third column in from the left, moving to the right, is the length of the recession. So that first one you can take a look at started in November of 1948. And ended in October of 1949. So the duration was 11 months. That fourth column in, was there a market low? Did the stock market reach a low during that recession? Yes, it did. The distance from the start of the recession was 6 months in from November of 48. And of course, the distance from the end was 5 months from the end. And you can follow this through on different time periods. One that seems a little similar to where we are today is July of 81 to November of 82. It lasted 16 months. There was a market low in there, and it was 12 months from the start of the recession in July of 81. On average, if you look at the blue bar going across the bottom, the length of a recession is 10.3 months. That's going back through these recessions going back to 1948, 49. And the distance that the market reached its low was about 6.5 months in. And it's noteworthy that not every single time did the market reach a low. November of 2001, that March 2001 to November 2001 recession, when the planes flew into the towers, the market actually bottomed out 18 months after the start of that recession. So that's the one instance of those grouping of recessions that we've studied that did not have a market low during the time of the recession. But historically, those come about the 2/3 mark during the recession. So about 6.5 months in. The strength of the labor market would suggest that this point is not yet on the immediate horizon. As J.A. said, unemployment is at 3.7%. The initial jobless claims come out this week. We expect those, at least the initial forecast is that those would be down slightly at about 235,000. And we have a strong labor demand based on our economy at this point. So perhaps we've got some more volatility to come in the markets.
Yeah, I think it's worth noting too that in many of these time periods of recession, the market bottomed out even quicker than 6 months in. Several of these are 1 month in, 2 months in. On three of them, 2 of them were 1 month in. So that brings me to the next slide, which talks about investing while the market is low. You could look at that previous slide and say, well, why don't I just wait, or just thinking about a recession. If everybody's predicting a recession to come, why don't I just wait till the recession and then invest? Well, the market normally is forward-looking. It's always forward-looking. And as we just looked at, oftentimes the market bottoms out well in advance of getting through a recession because the market is looking ahead. And this kind of provides some additional data around that. The data here on this slide is looking at investing money into the S&P 500. This is, again, the index that Tara talked about at the beginning of the presentation. When the S&P 500 has reached bear market territory, which is defined as being down 20% or more. So we've reached that this year. Earlier in the year, we're not quite at 20% now currently, but we have reached bear market territory. And I'm focused on these purple bars. So they are the average of including times of recession and non-recessionary times when we've just had market corrections of 20% or more. The point here is that if you've invested money when the market has been down 20%, whether or not you've timed it perfectly or not doesn't matter. The fact that you've invested when the market has been down 20% has paid off for investors that have been able to stomach, investing while the market has been volatile as it has been this year. As you can see on the left, the purple bar here that goes down, it says 15.6%. So if you invested at 20% down on the S&P, you still had, on average, additional volatility or downside volatility of over 15%. But if you measured out 6 months from the time of that investment, even having gone down from when you first put money in, on average, you've been up 4% at 6 months. And on average, at 12 months out, you've been up almost 12%. So that's factoring in that you haven't timed the market exactly right. You've just invested at a time when the market's been down, S&P down 20%. And again, it's paid off for the folks that have been able to do that. So it goes back to our process as well, which is not to try to time the market, but to acknowledge that time in the market is more important than timing the market. Mm-hmm. Which brings us to the next slide I'll let Tara talk about.
Yeah, that was a great segue. And this slide just shows us that the data supports staying invested. We don't want to miss the best days in the market. And so just to walk through the chart, as we're looking at it, the decade, so we're 1930 through 2020. We have the cumulative price returns. And then, so basically what this is saying is during that decade, we had a negative 42% price return. If we excluded or took out, you missed those best 10 days. And this is just 10 days over the course of a decade or 10 years. Your cumulative return, you would have been down 79%. And then, of course, that's annualized in the next column. So in the 1930s, I'm just highlighting during that decade, negative 5% price return. If I had missed those best 10 days, and we don't know when those best 10 days are going to be. So that's why we stay invested. We would have been down 15%. And you can see, let's say we go to the 1950s. So we have a price return of 257%. If I had missed those best 10 days, still would have done very well, but I would have been at 167% return. And you can see what that looks like annualized. If we take a look at the average since 1930, the price return is just over 100%. If I had missed out on those 10 days, just 10 days per 10 years, my return would have been at 36%. And so what the bullet points here highlight is investors who missed those 10 best days in a given decade would have seen a 70% lower return over the course of that decade on average. And another thing to note here that we want to make sure to include is 28% of those best days, 5% or more, took place within the first 2 months of a bull market. And then again, we're going back to the chart S&P 500. I think this just highlights staying invested and being able to see those rallies or returns. This shows us since the low point that we had back in October we snipped this chart right before we hopped on. So this is through today. What we're seeing here is around or approximately a 10% return just during that short period of time.
Yeah, and to summarize in just a few bullet points, this is always a challenge for us to do, but to try to boil down the U.S. economic outlook and the U.S. market outlook, we just took this slide from our last presentation because we think it's still valid today that the recession risks have materially risen, and the overall recession signal has been read the last 3 times, the last 3 calls that we've done together. We see high inflation and the Fed tapping the brakes of the economy by rising rates are the key headwinds. We think there's a narrow path for a soft landing scenario, but it does rely on the Fed turning course. It also relies on a resilient consumer and or a corporate reluctance to invoke a full-scale layoff cycle. And as we had mentioned, we're not seeing that right yet. We think the Fed continues to raise interest rates, probably through the good part of next year. As far as the market outlook, we think the current headwinds include Fed tightening. This cycle will continue, as I mentioned. We think that the midterm elections did not turn out like what we had thought or had spoke about earlier, but this also has some pressure and weight on markets. We continue to believe that the markets will experience heightened volatility until the visibility is restored regarding the path forward for the economy and for earnings. And then historically, bear markets are rare and typically provide good opportunities, as we've mentioned, to buy into good companies. We still remain focused on dividends and having a long-term outlook for investors. And so we wanted to bring some year-end planning strategies to the table because we think there's a window of opportunity for these. If you're on the call and you're our client, know that we are taking action on these for you. If you're on the call and you're not a client, just know that this is part of our process as the year winds down. It's also one of the reasons why we don't do a webinar in December, because we have a lot of these things going on for our clients, and we're taking a proactive approach to managing not just the investments, but the full relationship. So I'll start off with the top bullet point, tax loss harvesting. It's a fun way of saying that we're going to manage those losses in your portfolio. And whether it's good times or bad times, not every investment will be a winner. Fortunately, a losing investment does have a silver lining. And that means that you could potentially use that loss to help you lower your tax liability against any other type of gains or against your income. And this is simply called tax loss harvesting because we go in and we actually realize a loss on those investments that are down below what you paid for them. It's one of the many tax smart strategies that we use to help clients minimize their taxable income legally. And so it simply works like this. You sell an investment that is underperforming and losing money, and that way you capture that loss this year before the end of the year. So you've got up until the end of the year to do that. And then any other gains that you've had that are realized gains, or if you have no realized gains, you can use up to $3,000 of that loss to offset your ordinary income. And then finally, you reinvest the money from that sale into a different security that meets your investment objective and your asset allocation strategy and can better position you for the future. So that's been an important one that we've used and we will use here coming up this December. We have had some trades earlier in the year when we reallocated that caused clients to have realized gains. And so now is the time that we would offset those. The second one there is required minimum distribution. So if you have an IRA, a traditional IRA, you would be required to take a minimum distribution if you were 72. or older. So in the year that you turn 72, you're required to take out a minimum distribution per the IRS guidelines. And you have to satisfy that by December 31st of the year in which you turn 72. Or you can postpone that first one until April 1st of the following year. But then you have to take 2 distributions, the one from the year that you postponed and the one in the current year. So this would be 2023. And so those distributions, for most of our clients, those come out December 1st. There are some client situations where we are drawing those down monthly or earlier in the year, but most of our clients are taking those out on 12/1. So this week, those are coming up. And if you're on this call and you have an IRA and you're 72 or older, be expecting that distribution to come out if you are in that category. And so that's it's really classified as ordinary income when it hits your tax return. However, you can look at the third bullet point, that of charitable giving, to reduce the required distribution. And the way this works is you can simply give some or all of your required distribution to a charity or 501c3, and you can reduce that income that hits your tax return by the amount of that gift. And that is up to $100,000 total to one or more charities directly from your taxable IRA instead of taking the RMD. So it does give you some reprieve. I know a lot of our clients are just taking that standard deduction on their tax return. And so they're really not getting the benefit of any charitable giving unless they're using something like this qualified charitable distribution from their IRA. So it's a good way to plan here at year end. Again, most of our clients we have talked to about this and are putting plans in place to help them with that. If you're on this call and that's something that you want to talk more about, feel free to email us or call us, and we're glad to discuss with you.
Absolutely.
Tara.
Yep. So next bullet point here is look to improve the interest on your cash. First, I would just ask you to take a look at your cash position, or we'll call it your cash reserve. Are you keeping more in that account than you need to? Definitely want to keep, a rainy day or emergency fund. Any short-term expenses that you might have coming up, it's fine to keep those in cash. Above and beyond that, we talked about before that inflation is still above 7%. And if we're keeping too much money in cash, what's happening is your purchasing power is decreasing, and we don't want it decreasing too long or long term. So that's the first thing I would just ask you to do, is just reevaluate your cash position and your cash reserve. Anything that you're not going to be using, look to invest that long term. And the other thing in regards to improving your interest, what I would ask is the institution that you're working with, know what rates they're paying. A lot of the local banks that I often see clients using, the rates are not good. So we're talking about a savings account at 0.01%, when other savings accounts, maybe not at a local institution, at an online bank, are now paying above 3%. And that's a guaranteed rate of return. That could be a significant amount depending upon, the amount of cash that you have. So I want you to take a look and reevaluate that. The next point is to maximize your retirement savings. First, if you're still working and you have a company 401k plan, make sure that you're going to reach that max prior to the end of the year. A lot of employers will require you to make an adjustment to your percentage that you're contributing prior to December, or prior to whenever that last pay period is going to be. So go in, calculate how much you've contributed. Are you going to meet that max? Remember, if you're over 50 years old, you can put additional money into your 401k or 403b. For IRAs, this is also tax advantage retirement plans. We have a little bit more flexibility on contributions, but we'd like you to take a look at making sure that if you're eligible based on income, that you're maximizing those as well.
I'll take these last couple of bullet points, and the next one here, time is kind of running out on that, but there still is a little bit of time, so we wanted to mention it. This revisiting of Medicare supplement options. We have had clients that have been able to sit down with a professional before the December 7th, I think is the deadline on this. So it would need to be done quickly, but just to assess spending and needs from a healthcare standpoint. Look at all that you've spent on prescriptions and otherwise, and then really making sure that you're in the right Medicare supplement plan. And we've had clients being able to save money by doing that. So if you haven't done that in a while or never done that, we would recommend that you do that. Reach out, and if you need to know who to reach out to, let us know. We'd be glad to provide that to you. And again, we've got a little over a week, so December 7th is the deadline on that. And then the final bullet point there is just projecting taxable income. And we have historically helped clients do this from time to time, but it can be worthwhile, especially if you have sold property or you've had other one-time events that have occurred during this year, during 2022, this taxable year, that potentially will impact your income. Just to be able to reach out to your tax preparer or just do it yourself to go through and just look at the year, what your income has been. And if you need assistance with that, I'm sure your tax preparer would be able to help you. For something we can help you with as well, we'd be happy to do that. But doing that as opposed to waiting until April and realizing, man, I've got a big tax bill, or maybe there was something, one of these strategies or year-end planning you could have done to reduce taxes before the end of the year. So that would be on the list as well, just projecting taxable income. Which brings me to just we always like to close these webinars with some biblical wisdom and truth. And this verse specifically comes from the Gospel of John in chapter 16, verse 33. These are words of Jesus that he said to his disciples towards the end of his ministry and life on earth. And he said, "I've said these things to you that in me you may have peace. In the world you will have tribulation, but take heart, I have overcome the world." So just as we enter this Christmas season and season of Advent, I think it's important for us to remember what it is about, that it is to celebrate the birth of a Savior in Jesus, and he lived a perfect life on this earth and then went to the cross as a perfect sacrifice for sins, that people may be saved to eternity with our Lord and Savior. And so we believe that here, and we pray that all of you would do the same and just put your hope and faith and trust in him. And also, as difficult as it is, the world wants to pull us from any of that focus, right? So it can be challenging during the holidays to keep our focus on where it should be, but we're committed to that. We would challenge you to do the same as well. And then just to go back also just to this peace, the peace really is the peace that comes from the Holy Spirit that is given to us. And it's also peace from just the promise and the assurance of salvation for his children. So we would just encourage you with that. If you have questions or want to talk to any of us about that, we'd love the opportunity to do that. And so that's our closing with the biblical wisdom and truth. We do want to thank you guys for participating. If you've been on this call and or previous calls, we've enjoyed doing these webinars this year. As Greg said, we're going to take a break in December. But we'll be back in January to continue and pick back up with them. We would like to comment and just say that if there's anything we've talked about, any of these planning items that you have additional questions about or would like to discuss in more detail, please reach out to us. Also, if you've talked with others who may be concerned about the market and the economy, please direct them to us. We'd be happy to have a conversation with them, to sit down or have a phone call with them just to discuss their concerns and try to bring some clarity around that. So we appreciate that. Beyond that, we won't see you again on these calls until after the new year. So maybe it's a little premature since we're not in December yet, but we'd like to wish everybody a Merry Christmas and a Happy New Year. We'll see some of you, and I'm sure talk to many of you before then, but Merry Christmas and Happy New Year.
See you guys.
Bye.